What does the latest lending data tell us about the state of the property market? Welcome to the Property Imperative Weekly, to the 20th of January 2018. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In this edition, we start with the latest lending finance data from the ABS. We had both the housing finance and the lending finance data out this week, and essentially it shows a story of some reduction in investor lending, but some growth also in owner-occupied lending, and very importantly, investor construction borrowing was also up. And in fact, 36% of all loans written in last month were for investment purposes. So it's down a little bit. The high was 41% in 2015, but it is really still very high. And remember that the Bank of England is concerned when 16% of total lending to households relates to investment purposes. So we think there's a lot more to do to get investment lending under control. And whilst many people are suggesting that the RBA and APRA should allow more lending for investment purposes, we think lending control should be, if anything, tighter still. The data also showed that first-time buyers were more active. Around 18% of loans written last month were for first-time buyers. This is up from a low of around 11 or 12%, but still well below the peak of 30% that we had a few years ago. First-time buyers are coming into the market thanks to the very generous offers in terms of low rates, but also thanks to the incentives from the various states, particularly New South Wales and Victoria. It's also worth noting that the loan size for first-time buyers is continuing to grow. The data shows that funding for construction is under pressure. And that means that whilst there have been recent rises in building approvals, our view is that the construction sector will be struggling through 2018, particularly in the high-rise areas of Sydney, Brisbane and Melbourne. The data from our small and medium enterprise surveys have shown that small contractors and small builders have less work in the pipeline ahead and are less confident about the future than they were 6 months ago. So the theory I'm developing is that the construction sector for residential will get compressed over the next few months. It'll be somewhat supported by continued investment in the commercial sector and also engineering investment. But overall, we think that the fall in residential construction that is ahead will be significantly larger than can be replaced by construction from the engineering sector or from the commercial sector. A number of analysts have also come out this last week suggesting that bank profits in Australia will be under pressure, and they call out a few different factors. The first is that international funding pressures are rising. So US Treasury rates have been rising recently, and as a result of that, the expectation is that international funding costs will continue to rise. Now that has the potential to impact the local banks quite significantly because many of them are funding their books from overseas. In addition, of course, we have multiple inquiries, including the Royal Commission, into the banking sector. I think 15, one of the analysts suggested this week. And that leads to a whole bunch of uncertainty and also a lot of focus amongst banks in terms of trying to answer all the questions, and that could perhaps dilute their focus on driving their business. Of course, you've got the question of household debt. So the ABS restated the household debt ratios this last couple of weeks to take account particularly of lending within superannuation funds. As a result of that, we are now at 200%. So the amount of debt relative to income is now above 200. That's a remarkable figure. It's one of the highest around the world and highlights the risks that are ahead in terms of the housing sector when incomes are flat and wage growth is also looking pretty sick going forward. So with households under pressure and very high leverage ratios, any slippage in terms of home prices would actually create potentially higher levels of default amongst the banks. Now, defaults in the mortgage sector have been low for a long period of time. Although APRA recently said that they would have thought that default rates would have been even lower given the very low interest rate. What we're seeing is now more households getting into difficulty. Our mortgage stress reports highlight that. And so going forward, our expectation is that we will see more households getting into difficulty. Those difficulties will flow on into defaults, and that will put more pressure on the banks. But the other point is that banks are totally reliant on the mortgage book for their profitable growth. And so we're seeing this very strong surge into lending, particularly for first-time buyers and for owner-occupied, and indeed now some investment loans. So the appetite amongst the banks to lend is still strong. And there was research that came out this week that suggested that banks were willing to take a 20% deposit from another property. In other words, grab equity from property A and put it into property B and use that as a deposit against which to mortgage. So this kind of cross-leverage between one property and another is something that is worth thinking about, because it highlights the degree of interrelated risks that we actually see in the market. Another example of that is the bank of mum and dad. The bank of mum and dad simply means people borrowing from their parents to buy into the property market. And the data that we've got suggests that now the size of the bank of mum and dad is around $20 billion, and that puts them within the top 10 lenders in Australia. So our research shows that around 55% of first-time buyers currently are only able to buy into the market thanks to help from the bank of mum and dad. The average loan from the bank of mum and dad is around $88,000, and it's been rising quite fast over recent times, although we seem to have hit a bit of a hurdle now insofar that at around $88,000, $89,000 there seems to be a cap above which parents are unable or unwilling to go. And if you want to know more about the bank of mum and dad, there's a separate video on our blog that we published a few days ago. It's this cross-leverage which I think is a risk which is not fully understood in the market yet. And because the banks are still willing to effectively take equity from one property and lend against it to fund another property, it continues to stoke the fire. We have some fundamentally critical questions to ask about risks in the property sector. The ABS released their employment data this last week, and it's 5.4%. They actually corrected the previous month at 5.5 and down to 5.4. But what's interesting is that the number of hours worked was down in December. That's probably to do with the holiday period. But overall, it was a bit of a mixed set of results. And the question that we have to ask is whether the employment number, in any case, reflects reality. There are other metrics out there from other organisations suggesting that real employment is nearly double, so perhaps 9 or 10%. And that's because many people who are classed as not unemployed, because they're not looking for work, are not counted in the official numbers. And certainly our research and our surveys suggest that there are many people who've given up and essentially are sitting on the sidelines. So maybe the real employment number is a lot higher than the official figure. And whilst people can talk about creating lots of jobs, the fact is that jobs don't necessarily translate into higher wages. And that, of course, is one of the critical factors that we're seeing in the local market. Another piece of information came out this week from the ABA related to trust in banks. Their research showed that consumers were trusting banks more than 6 months ago. However, if you look carefully at the data, on an international basis, the level of trust in banks in Australia is still 4% lower across the international survey that the ABA refer to. So whilst there may be a small improvement, there's still a lot to do in terms of getting confidence levels and trust levels up in the banking system in Australia. And our own view is that until we've got the results of the Royal Commission and some of the other pieces of inquiry that are currently running, we won't really have a very good view. There is a systemic and endemic problem of low levels of trust in the banking sector, and all the recent scandals don't help at all. We were also involved in one of the stories of the week, looking particularly at the refinance of interest-only loans. So we ran some calculations based on our surveys as to what proportion of those with interest-only loans would not be able to refinance those loans because underwriting standards have increased and tightened in recent months. And we ran some calculations, and over the next 2 or 3 years, we think that there are around 60 billion worth of interest-only loans who will not get refinanced back to interest-only when they next come up for review. And essentially what that means is that many people will find that the repayments they have to make will perhaps double because of the move from interest-only to principal interest repayments. And some people will probably not be able to afford that and will have to sell their property. So the 60 billion is going to hit predominantly next year and the year after. And that's one of the reasons why we think that the property sector will continue to struggle for the next 2 or 3 years. And there are some parallels that you can draw between the interest-only problem that we've got in Australia and what happened in the US in 2005, 2006, up before the GFC, because there we had borrowers on very low rates of interest, suddenly finding that the rates of interest rose, their repayments increased, and they were unable to make those repayments. And as a result of that, they started to default. Now, the size of the problem in Australia is probably not as big, and it's possibly manageable, but nevertheless, if the research from UBS is true, and there are many people holding interest-only loans who really don't know that they've got an interest-only loan, many will be in for a rude surprise down the track. So in summary, well, clearly banks are still quite desperate to lend. Not surprising, because it's really the only game in town when it comes to their profitability. Households continue to remain under pressure, and there's very little evidence that we're going to see incomes growing anytime soon. So therefore we would expect more households to struggle with very high debt levels, and the over 200% now data from the ABS is really underscoring the risks that are in the local market. So going forward, our expectation is that things will continue to muddle on over the next few months. Property prices will continue to slip, and household debt will continue to rise, because whilst there has been some tightening amongst some lending standards, overall lending is still growing too strong, and within that, investment lending is still too strong. So the Property Imperative Weekly is a summary of the latest property and finance news. If you want to drill into more details, you can go to our blog, where you'll find a series of articles on most of the subjects that we've discussed today. So that's the Property Imperative to the 20th of January 2018. If you found this useful, do leave a comment, do subscribe to receive future updates, and check back again next week. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for watching.